Town Bank Mortgage, NMLS number 512138, is an equal housing lender. This podcast is for informational purposes only. And now, the man born with a 5 o'clock shadow and with the NMLS number 2028201. He is a gentleman. He is a scholar. He is
Tyler Cralle.
All right. Definitely felt like January today, at least in Wilmington, which makes sense because this is Wilmington Mortgage. And I am the aforementioned host of this podcast, Tyler Cralle, of course, loan officer, Town Bank Mortgage, right here in Wilmington, North Carolina, where we break down the top stories impacting mortgage rates every day, every weekday, every single weekday. Monday through Thursday, I think is what we've decided on. Monday through Thursday. And rates have actually calmed down a little bit. They did spike at one point. They were up like almost 4 basis points, the 10-year. And then we saw a little bit of a pullback, and now it's only up about 1 or 2 basis points. And we're going to talk about that. It has to do with the dollar and the weakening of the dollar. President Trump made some comments in Iowa that caused a little bit of a movement there. We are going to get into that, but we're going to start with what is happening tomorrow, and that is a Fed meeting, which, like I said, no one is expecting a rate cut, but we sort of had that confirmed when Nick Timiraos, a.k.a. the Fed Whisperer, wrote his signature piece before the Fed meeting. So if you've ever paid attention to this, Nick Timiraos, usually the day before, maybe day of, if there's a lot of controversy and they're not exactly sure, he'll kind of give you forward guidance on what is going to be happening at the Fed meeting. He was the first one to report on the surprising 50 basis point increase when the Fed was in a hiking cycle, or the beginning of a hiking cycle. And then he's been sort of out there kind of letting you know, there was going to be that third rate cut. And so he is, once again, confirming what we kind of already knew. And that is there is not going to be a rate cut at this meeting. And in fact, they don't really know when we could get a second rate cut. So he wrote in the Wall Street Journal, Federal Reserve officials this week are expected to stop cutting interest rates. The harder question is what it would take to start again. Now, according to Timiraos, cuts don't restart without one of two things: a job market that breaks, which we haven't seen any evidence of, or inflation that convincingly resumes its march toward 2%. Right now, by all metrics, CPI, PCE, whatever it is, we got inflation at a higher end of that 2% number, 2.7, 2.8. Not exactly confidence that we are moving back to that 2% number. Now, of course, a lot of people out there try and say, okay, well, what about, some of these other metrics like trueflation? I've seen that before. The Fed looks at PCE. That's their preferred inflation gauge. That's at 2.8, 2.7? It's high. It's higher than they would like. It's not as high as it was, but it's higher than they would like. Timiraos also notes that December's rate cut wasn't exactly a kumbaya moment, as I've talked about many a times here. In fact, it was Jerome Powell, oddly enough, who is now facing an investigation by the Department of Justice. Trump still doesn't like Jerome Powell. Powell was probably the reason, and Timiraos was the one that wrote about this back in December, was the reason for the December rate cut. The fact that Fed officials were pricing in that there wasn't going to be a rate cut, but still voted for it, means that Powell used the juice that he still has to get those more shakier members on board with the cut. And then they, the dot plot said that they weren't expecting one. So it was sort of kind of like a protest for them to say, hey, I wasn't really on board with this. Showing, like I said, kind of ironically, that Powell was the reason they even got a third rate cut. So there are people that think, Powell is trying to stifle President Trump and his agenda, when in reality, without him, they wouldn't have even gotten a third rate cut. So that's what sort of Timiraos was noting. We did talk yesterday about Goldman Sachs. I think we did. I'm not sure if we got to that story. David Merkel, chief economist over at Goldman Sachs, says he expects the next Fed cut not to be until June. That would be the month after Jerome Powell leaves his chair position in May. And then Deutsche Bank's chief U.S. economist Doesn't see one coming until September. So basically what Timiraos is saying, no rate cut at this next meeting. We don't know when the next one's going to happen. And by pretty much all accounts, it's a little ways away. Not going to be until the second half of this year that we're going to see a rate cut. So if we want to see mortgage rates fall, we're going to need to see some beneficial movement in inflation data, which will help pull the 10-year down. And of course, we can't stress this enough in the mortgage industry that mortgage rates front run Fed decisions. And so mortgage rates could fall before we get to that point where the Fed is actually deciding to cut or voting to cut. It'll already be happening to mortgage rates. So how it's going to happen is, like I said, inflation, and then other metrics that are going to help move the 10-year. And today we actually had an interesting movement in the 10-year. So I said earlier today, right before the close, we saw mortgage rates jump, bond yields jump, and they've kind of come down to, I think, everyone's approval. But what caused that? Well, it had to do with something that's happening with the U.S. dollar. And Robin Brooks, who I've talked about before, a senior fellow with the Brookings Institute, has warned before about the dollar drop. And just yesterday wrote in his Substack that the recent drop in the dollar is no fluke, saying, quote, "The dollar is falling swiftly, in line with my call that 2026 will see a resumption of dollar weakness after the hiatus in the second half of last year." Brooks argued there were two main forces behind this. One of them is policy uncertainty or chaos, which is the last time we saw this much dollar movement, at least in negative territory, was during Liberation Day back in April of 25 when Trump announced his tariffs. And while everyone knew the tariffs were coming, they didn't know exactly what they would be, and were kind of surprised at how high they were, and sort of just the kind of catch-all that was those tariffs. And the markets, if you remember, did not act kindly. And so we're seeing movement in the dollar that we haven't seen since that Liberation Day move back in April of last year. And then there's also this sort of, it seems almost contradictory, which is foreign investors are bullish on U.S. growth. So they are expecting that the U.S. is going to grow, but they are not bullish on the U.S. dollar, which actually can kind of make sense, even though it seems like it wouldn't make sense. Because as we all know, if you want to invest, if you're a foreign investor and you want to invest in the United States, you have to get dollars. Now, one of the ways that you can get dollars is by running a trade deficit with a country. So like if you're selling products to businesses in the U.S., you will then get those dollars. They're going to pay. You're going to say, hey, you know what? Pay me in dollars. I'm going to give you goods. You're going to give me dollars. I'm going to use those dollars to invest in the United States. Well, the trade deficit is shrinking, if you've noticed, which means we're doing less business, or there's, I should say, less dollars floating out in the international markets. And so then one of the other ways that you can get U.S. dollars is currency exchanges. And so usually either of those things, because it's demand for dollars, usually will have a positive impact on the dollar, and that the dollar will then rise because demand for the dollar has risen, right? Because that's supply and demand, right? When demand rises and supply remains constant, prices go up. You know, vice versa. When demand drops, supply stays constant. What happens? Prices fall. And so when people are saying, hey, I want dollars to invest in the U.S., that should cause dollars to rise. Except for, and this is always the case, there's always some like weird finance trick that you can use to mess things up. So people are saying, you know what? We think there's going to be a lot of growth. We think Trump is going to be pumping growth. He's going to want growth, but that could come at the expense of inflation. Now that's a problem, right? Because if growth is 4%, but inflation is 4%. Well, then there's actually really no growth. It sort of cancels each other out. So they're saying, hey, we think there's going to be growth, but we also think there's going to be a depreciation of U.S. currency. So one of the ways that you can counter that is something called a carry forward trade, which is essentially you're locking in the current exchange rate. So if you're in, Europe, you're in wherever, and you're like, you know what, looking at my currency, the euro versus the dollar, and you're like, I want to lock this in because, if you wait and then the dollar depreciates, you could actually lose money on that transaction when you convert your dollars to euros. So you can lock that in. And so one of the ways that trade works basically is that, like any sort of hedge trade, is that when you're locking in something, you're basically selling your assets, dollars, to lock them in to buy them back later. So they're pumping dollars onto the market. So it's almost like a self-fulfilling prophecy where, so the reverse side of your trade is pushing those dollars onto the market, and all those people pushing those dollars. So the more and more people that engage in this trade means there's more and more dollars out there that are available. So you're increasing the supply with demand staying constant. What happens? Prices fall. So it's like a self-fulfilling prophecy. Now then, when you have to unwind that trade, the opposite happens. All of a sudden, supply drops, price rises. And so, like I said, it is kind of funny that sometimes people worried about something happening can actually cause that thing to happen, at least in the short term, by the moves of the market, if that makes sense. Hopefully. And so the dollar index actually fell 1.3% on Tuesday and is now down almost 4% in just a week. I mean, that's a big move for a currency, especially as important as the US dollar, which is the global reserve currency. That's a big move. That can have major implications. And like I said, there can be other impacts in financial markets. So for example, when you see the dollar looks like it's going to depreciate this year, if you're a bond investor, because, dollars matter, if you think the dollar is going to depreciate, you're going to require more yield on your bond. So they're going to say, I'm not going to buy that. I'm going to need more yield on my bond to make up for the diminished dollar. So that's why falling dollar, the price of the dollar, can actually cause bond yields to rise. Like I said, hopefully that makes sense. And then President Trump weighed in. That's really caused the dollar to lose value. He was asked at an event in Iowa what he thought about the recent downward moves in the dollar. And he said, I think it's great, the value of the dollar. Look at the business we're doing. The dollar's doing great. Now, then he also went on an interesting, not a tirade, I don't know what you would call it. It's like a, kind of like a, I don't even know what you call it. But he basically started talking about China. And, he's always accused China of being a currency manipulator, which they are. They 100% are. I'm not saying they're not. But what's funny is they used to manipulate the currency down in order to increase their trade surplus. And then at one point, they started actually manipulating the currency up to help prop up their economy. Because when you devalue your currency, sure, it makes your exports more valuable, but it causes inflation. Because what is inflation? The inflation is pure and simple, devaluing the dollar. You can now buy less with your dollar. And so China has no problem devaluing their currency because they believe in sort of a mercantilist system, which is all about, trade surpluses is the way to prosperity, which it's not. it's not. It's not necessarily a bad thing, but it's not, that was an old way of thinking. That was an old sort of economic theory, mercantilism, which was way back in the day what people thought, that having positive trade surpluses was the key to prosperity. And China believes that. And so that's why they'll do everything they can to make sure they run these big trade surpluses, which, like I said, you can see very clearly in their economy how it doesn't help them, because they're running record high trade surpluses and are having massive problems with their economy. When their housing market's having problems, they have insane amounts of debt. China's economy is not good. In fact, we have deviated. At one point, people thought China was going to surpass us before COVID by 2021, 22, and their growth has stalled significantly. Like I said, while they're running record trade surpluses. So if trade surpluses were all that mattered, they'd be killing it, and they're not. So textbook example of why mercantilism doesn't exist. All right, let me get off my soapbox. But if you wanted to know why we saw a little bit of a rise in bond yields today, it was because of this whole dollar situation. Oh, and then before we go, I'm going to go over my 15 minutes, but that's fine because we got a lot to get to. Consumer confidence. That's another reason why I was kind of surprised that bond yields rose, because bond yields I thought were going to fall. We got a consumer confidence report, and I was amazed at the lack of coverage of this. I thought this was kind of a big deal. So every month we get consumer confidence from the Conference Board. Consumer confidence fell to an index of 84.5. It was a 9-point drop to start the year 2026. Economists were expecting a smaller drop to 90.6. So 9 points. Lowest reading since May 2014. An 11-year low. 11-year low. Almost a 12-year low. 11-year low. That's for those doing math at home. That was worse than COVID. COVID was only 6 years ago. This was an 11-year low. That's not good. And it was across the board. Weakness was broad-based. Present situation index fell 9.9 points to 113.7, signaling that households feel materially worse about their current situation and labor conditions. And then the expectations index dropped almost 10 points to 65. Anything below an 80 reading historically has been consistent with a recession risk. And we are now 15 points below 80. We've been below 80 for a while. So, yeah, I mean, that was a pretty bad report. And I was like, oh, man, we're going to get a jump in rates. I mean, we're going to see rates fall. This is going to be a good thing for mortgages. And it didn't. And I think it's because this confidence report got sort of overshadowed by what was happening with the dollar. So, the dollar, everyone all of a sudden was noticing, wow, the dollar's falling today. And then Trump comments on the dollar, and then it just goes, boom. The dollar just plummeted. The biggest drop of the day. And like I said, it recovered a little bit, but I think that's kind of overshadowed this report. But, oof, man, consumer confidence was not very good. And so I think maybe that's one of the reasons why we saw bonds kind of pull back, because they said, okay, yeah, we get the dollar and we get the, carry forward trade and all of that stuff. But this consumer confidence thing could be an issue. Because remember, we talked about that report earlier this week that, it was U.S. consumers that were pushing growth in 25. It was not just AI spending. In fact, the majority of it was consumer growth. And so if we see consumers pull back, it's going to be hard for the economy to grow at the pace that would be needed to continue this strong growth that we've seen. 4 or 5. I mean, I think we've heard estimates of 5% fourth quarter, which is crazy because remember after the shutdown, everyone thought we were going to have a negative print. Kevin Hassett came out and said that. So yeah, kind of a interesting day with bonds kind of going like this a little bit, like a little heart monitor. But yeah, so the 10-year kind of moving back a little bit after that dollar controversy. But yeah, that consumer confidence report did catch me by surprise. But all right, we went a little bit over today. I think it was allowed because we did have that interesting thing with the dollar I had to explain, which I don't think I did a very good job of, but I tried. And then we're going to talk about consumer confidence. And then tomorrow, the Fed meeting, let you know what Nick Timiraos thought. He's got his ear to the ground. He knows what's going on. So we will be talking about that on tomorrow's show. Big day, Fed meeting. Probably the only thing we will be discussing on tomorrow's show. But you guys enjoy the rest of your Tuesday. We'll be back here Wednesday for another edition of Wilmington Mortgage. And remember, as always, do not wait to buy real estate. Buy real estate and wait.